Good afternoon, everybody. Thank you for joining us for the presentation of our interim results ending April 23. So just a brief summary of those who don't know us. I'm Gareth Davies. I'm Chief Exec. I've been Chief Exec now for 5 years. I've also been with the business with Wynnstay since 1999. So my background is very much agricultural sales and commercial sales management. And prior to my appointment as CEO, I was overseeing the agricultural division for the previous 10 years. So just introduce Paul to you.
Just complementing the sentiment of an experienced management team. I've been with the business over 35 years, but have just recently announced my intention to retire.
Okay, thank you, Paul. Slide here gives an overview as to what the business is for those who's not familiar with the business. So our business is very much about supplying farmers and customers in the rural communities. The business itself started as a cooperative in 1918, becoming a PLC in 1992, and onto the AIMS market in 2004. I'm often asked the question as to what does our business actually do? But I'll summarise it very clearly, really, that we help farmers, both arable and livestock farmers, produce food in a sustainable manner. We have a very clear strategy, and it is based upon supplying both agricultural inputs and also services to farmers within Great Britain. We don't export as such. We're predominantly GB mainland, and we supply most products with the exception of agricultural machinery. So therefore, we don't supply tractors and combine harvesters, etc. Our product portfolio is as much as 25,000 SKUs or thereabouts. A key difference to our business to many is that we do have a balanced business model. By that, I mean that we do supply both livestock and arable farmers. And generally speaking, our revenues from those two divisions are pretty well similar. The fact that we supply both sectors of farmers basically gives us a natural hedge within the business. Some of you would have heard me say previously the term horn v corn. So what that basically means that you'll often find that the arable farmer is doing particularly well and therefore having good returns for what he's doing. But because wheat is then used in feed materials to feed animals, sometimes the cost of production for those people is more than it was. So therefore, the arable farmer is doing well, and maybe the livestock farmer not so good. And that actually has a reverse as well. That natural hedge within our business does help us deliver consistent results. The slide here shows that we actually report in two divisions. Now that's agriculture and specialist agricultural merchanting. Within agriculture, we have a feed division, which manufactures and supplies feed to a range of animals. Arable, processing fertilizer, processing seed, both grass and cereal seeds, small agrochemical business, but also complemented by a grain marketing business known as GrainLink. A subsidiary within agricultural division is Glass and Grain Limited, which is based up in Lancashire. So it's actually on a small dock on the River Lune. The Glasson business trades feed raw materials, some of which are imported into that dock. On the dock side also has a small manufacturing facility. And whilst the rest of the business manufactures feed for larger farm animals, this business actually manufactures feed for pet and wild birds. And also within the Glasson business is our fertilizer blending operation. The other division is Specialist Agricultural Merchanting, which comprises of our 53 depots, which predominantly cater for farmers within the communities. These depots are very akin, really, to a builder's merchant. So effectively 80% of the trade will be done with farmers on account, no different to a builder. But at the same time, both you and I can go into those builders merchants and into our depots to be able to purchase product either by cash or card. Again, a subsidiary within a division is Young's Animal Feeds, which manufactures and distributes equine products. The reason for the fact that Glasson and Young's are in the subsidiaries is that whilst fully owned by the business, they do actually supply product to some of the competitors that we have as Wynnstay. And whilst those competitors are fully aware that the business is owned by Wynnstay, it does give a difference that the invoice may come from Glasson or Young's Animal Feeds. Our routes to market are varied. Farmers come and collect from the depots, have product delivered to farms. So effectively, those depot collections could well be 2 or 3 times a week, same farmers. Whilst in the agricultural division, most of those products are either in bulk form or full load form and will be delivered to farm. Whilst at the same time, you'd often find that we have the same customers in the depots as what we do in the agricultural division. Our link with farmers is twofold. Either expert advisors who by appointment would go and see farmers and discuss their business and their requirements. And we'd have advisors across the whole sector, being dairy, beef and sheep, free range eggs, arable, for example, and also going to the depots. And whilst at the depots, they will also have the opportunity of taking specialist catalogues with them, which would be dairy, beef, sheep, or poultry. And we'd often find that when we go into new areas, particularly new areas, that these catalogues are very similar really to an Argos catalogue as such. People will take these catalogues away and in due course would be in touch, having seen something maybe on a certain page that have a certain interest in. And very much in its infancy form is our digital platform. We have about 23,000 active accounts now at this moment in time. And of those, 3,000 are signed up to the digital portal, in fact. But the majority of the activity on that portal is people accessing their accounts and looking to pay by that form. The actual amount of online trading that we do is very small. And we do surveys across the industry and across our customers to understand how they want to deal. And certainly at this moment in time, whilst we do, as farmers do seek information in a digital manner, actually trading with people is fairly small. And the fact of that is that most of them are on accounts. Many farmers like to barter, and also their requirements will change from month to month, depending on weather conditions and seasonality, etc. That map there will give you an indication of where we actually trade. The map on the left-hand side is our market share within a certain area. And we're based on the borders of England and Wales. And that's where you expect, I guess, where our greatest market penetration is. But certainly over a period of time, we've spread out across England and right up into Scotland as well. And within the appendix of the presentation, there is a page showing our acquisitions. I think it's just over 34 now since 2004. The green circles indicate where our fertiliser plants are, either in the north of England and Montrose in Scotland. The orange circles indicate where our feed manufacturing sites are, predominantly on the western side of the country, because that's where the animals are. The exception to that being the recent Humphrey acquisition, which is down in Hampshire. And right in the middle is our seed processing plant at Shrewsbury. Size of the business, people-wise, it's just about 960 as we speak now. And the majority of the product we actually deliver to farmers within our own vehicles, 110 commercial vehicles as we speak. The right-hand map is an indication of where our depots are. And notice that they're on the left-hand side of the country because our model is based around livestock farmers. Arable farmers, which we deal with on the eastern side predominantly, would buy maybe 2 or 3 times a year a limited amount of product, being fertiliser, cereal, seed and agrochemicals predominantly. Well, the livestock farmer would buy a wider portfolio of products and may well go to those depots even 2 or 3 times a week, and they're based on the left-hand side. So just come into the half year that we've just reporting on then. I'm very pleased with the performance of the business. It's been robust, and the underlying performance is certainly in line with our expectations. So trading conditions have softened as we've gone into the new year, particularly into Q2 in some sectors of the agricultural community, which has resulted in weaker farmer sentiment in some sectors. And in contrast to last year, Glasson's blended fertiliser operations did contend with adverse stock value realisations, which has impacted our profits by about 1.5 million. But Paul will give you more detail on that later in the presentation. Over the period, volatility continues, certainly in commodities, and also inflation cost pressures have impacted some sectors. However, when I look at the business, our balanced business model of supplying both livestock and arable farmers with that natural hedge has certainly helped us as a business to smooth the variations in sector profitability. The balanced business model is very much core of our strategy. The financial base that we have, the strong financial base and balance sheet, has certainly enabled us to be able to continue to grow the business. And the recent acquisitions of Humphrey back in March 2022 and Tamer right at the beginning of this period will deliver long-term strategic benefits. In relation to the Humphrey business, it has delivered a positive contribution in the first half, whilst it is lower than what we would have anticipated. And the reason for that is avian influenza. The disruption caused by avian influenza reducing the number of birds to feed over the short term, and therefore reducing the amount of tons that we've manufactured into that sector. But however, in the long term, that business will certainly contribute to the long-term growth of Wynnstay. Tamar is the first manufacturing facility that we've got in the southwest of England as far as ruminant feed goes, and is very much an important strategic move for us, and it's certainly bedded in well over that 6-month period. And a small incorporation into the business is a trading business of SG Deakins on the border of Powys and Herefordshire, which came in December, and has certainly helped the business over that period of time. The financial strength that we have as a business has enabled us to continue investing in the facilities that we have, particularly feed and seed, and also a significant investment in renewable energy. And Paul will give you more detail of that later in the presentation. And in order to propel growth and take our strategy forward, I have made some significant changes to the executive team. Neil Richardson, who came into our business as MD of Humphrey Feeds and Pullets, vast experience in feed logistics and engineering, now takes the role of Group Feed Operations and Engineering Director. Andrew Evans, who was previously overseeing feed, in addition to sustainability, which he maintains, now takes on the role of Supply Chain and Innovation Director. And a new position that I brought into the business is Head of Strategic Delivery. This has been taken by Paul Godwin, who's been with the business for a number of years. And this role will be very much key to work with the executive team to ensure that we look for projects, look for opportunities to be able to deliver our strategic ambitions. So I think in summary of the first half, I mean, despite the short-term challenges that the business has encountered, we are now a bigger business, and we certainly have the capability of expanding further in line with our strategic plan. And now I'd like to ask Paul to go through the financial highlights.
Thanks, Gareth. Just to recap, our business model is very much what I refer to as absolute unit margin, which really means that underlying revenue is not necessarily the best metric to measure the performance of the business. And I mention that because the last 2 years have been a period of particularly inflationary environment for commodity prices. And that has been the story in the interim results that we have just reported. During that period, we have experienced just under 50 million of increased revenue, simply as a result of underlying commodity price increases, which we have had to pass on through to customers. That inflationary trajectory actually changed towards the end of this period. From the beginning of March, most prices are now downward progression signs. The impact on the net profit of the business during the period has been impacted by what Gareth's already alluded to, a one-off impact on fertiliser stock values, which is the total reverse of what happened during the previous year, where the company experienced a series of upward lifts in fertiliser values caused by events primarily around the Ukraine war. Towards the beginning of March this year, the global prices for arable nutrients did take a violent drop, some 30% fall in the price of ammonium nitrate, the primary product that we're involved in trading. Our position for manufacturing raw materials meant that that fall in prices actually created a 1.5 million stock impact on our bottom line results. Having said that, our underlying EBT was 5.25 million after incorporating that impact, and that has obviously fallen through to earnings per share, which was also impacted by the near 30% increase in the headline rate of corporation tax introduced from the 1st of April. The higher revenue numbers, although not necessarily contributing any additional contribution to the performance of the business, does have a substantial impact on working capital, and that funding requirement did cause overall net debt to increase to 10.5 million in the period. And I'll share a little bit more detail on that in the slides to come. But we are a strongly asset-backed business with 132 million of net assets, which represents some £5.90 per share. And we're very proud of our dividend record, which has shown an average annual growth of some 7% over every year since the company joined the AIM market in 2004. The interim dividend has been increased by 2%, and we're confident that we will be able to report the 20th year of annual growth when those numbers come through at the end of the financial year. The track record graphs are really just to demonstrate the trend line, the progression of the business over the last 5 years. The detail of the results, I think, have generally been touched on as far as the headlines are concerned, so I won't dwell on the income statement. The balance sheet, again, I've highlighted the asset-backed nature of the business and would just emphasise that we have no pension deficit on our balance sheet as we have no defined benefit obligations. As far as cash flow is concerned, the strong cash annual figure is probably better demonstrated on the next slide, which is an old-fashioned debt reconciliation statement, which shows profit in cash terms. Obviously, compared to last year, we don't have the one-off gains that were being reported, but the substantial outflow is evident on this slide as far as working capital is concerned, reconciling down to the reported debt numbers, which again are better described by reference to a net debt cycle graph, where the seasonality of our business is evident. A substantial build-up of working capital in the first half always reverses in the second half. The income that we're anticipating to come from the unwinding of the previous inflationary environment is likely to exacerbate that, and we are anticipating reporting significant cash balances at the end of the year as the interim peak reverses into the second half. Even though the peak at 10.7 million during the period, we still have substantial banking facilities of just under 30 million, with more than adequate headroom to fund the significant and exciting investment programme that we have in mind. Just by way of introduction for Gareth, to give you a little bit more divisional details, the segment diagrams here are designed to demonstrate the balanced business model that we operate.
So as an introduction to the agricultural division, I'll just give an overview here of the current agricultural trading environment. So the top of the table, or yes, the top half of the table, is very much in relation to farm outputs and commodities, so therefore what the farmers have for their product. You can see from this, there's been significant volatility in farm outputs over the past 18 months. And during the first half of our financial year, we've certainly seen farmer sentiment weaken in some of these sectors, particularly grain and milk. So if we take grain, significant swings there. So grain levels are now very much back to effectively what they were pre the Ukraine crisis. And this is as a result of large global stocks. Milk from at farm gate level did reach about 50 pence per litre, actually, which is a record level for milk, just about the turn of the calendar year. These levels have come back now as the supply has gone above weakening demand, although very much short, and particularly on a global basis from China. We're back now to about 36 pence per litre. Beef, we've seen a very, very strong beef market, again to record highs, certainly in the first half, weakened a little bit of late, actually. Probably as a result of the cost of living crisis having an impact. But on a very positive note, free-range eggs, which if you heard me saying earlier in the presentation, had suffered a little bit. We've now seen the price of egg turn now again to a record level, whilst at the same time, we've also seen a weakening of the feed price. And about 60% of the cost of producing an egg is actually feeding the hen. And the main ingredient of that feed would be wheat. So you can see really that the balance that I referred to earlier on certainly has an impact when it comes to how our customers are performing. But despite some of these sectors having a drop in income as such, certainly from farm outputs, what they receive for their materials, the bottom table clearly demonstrates that costs have also come down. I've concentrated here on what I see as some of the higher costs for our farmers, and that's been diesel, power, in other words. You can see that has dropped. Within the table, I've highlighted fertilizer by a table because it actually relates to what we spoke about with Glasson, and you can see those significant swings there. But overall, I would say, as far as challenges for our customers, it's right through the food supply chain, and that's labour, whether it be the supply of skilled labour, but also the increased cost as well. And that's true of whether it's our producers, whether it's ourselves, and the processors who process food into the retail chain. Giving an overview of the feed division, we've certainly expanded our geographical reach, and as a result of that, with the acquisitions, we've also increased our manufacturing facilities. However, during the period, like sales, they reduced by about 7%. So the differential between our actual at 1.3 and 7% is the differential from Tamar, the tons that came in from Tamar. The Humphrey tonnage, or the business, is actually separate to this because due to the earn-out period, we actually run Humphreys as a subsidiary for this period of time. This reduction is very much in line with national trend, partly for the reasons I've said earlier, a reduction in food going to free-range hens. And also in the second quarter, dairy farmers would have tightened their belts a little bit as milk prices were coming down. So whilst the free-range egg sector has certainly been challenging, the integration of Humphrey Feeds and Pullets into Wynnstay Agricultural Supplies is certainly on track. And we have now combined the brands to be rebranded as Wynnstay Humphrey Feeds and Pullets. As we look forward, the Carmarthen Mill project is certainly progressing well, and Paul will give you a little bit more detail later in the presentation. And as far as the Carn project is concerned, if you recall, when we bought the Humphrey business, we're operating on our lease at the current site, the Twyford site, which is the ownership has been retained by the Humphrey family. But we also bought a mothball plant at Carn, which would give us opportunities of considering our options as we go forward. And we're certainly still in that position as we consider what is the best option to go forward to give the best return on capital. We are committed to a feed manufacturing facility in that part of the world to service the M4 corridor and the southwest of England. But very much what we are doing, I'd like to highlight, is working with our farmers to deliver their environmental outcomes, which is a key point of difference for us. All the soya and the palm kernel that we source for our customers are grown in a sustainable manner. We've just carried out, we're engaged in a trial with free-range egg producers, actually, to feed a certain type of phosphate that will end with a reduction in the amount of phosphate that goes through into farmyard manure. You may be aware that in certain parts of the country, there are issues seemingly with agricultural pollution and maybe phosphates going into certain river courses. And also we're working with our suppliers in terms of methane inhibitors. We're already including a methane inhibitor in some of our feeds, and we're looking at extra trials as well to reduce the amount of methane that comes from ruminant animals. The balanced model within the arable division has certainly helped us deliver a strong performance. GrainLink, a marketing business, traded volumes as much as 27% above the same period last year. The majority of this increase coming in the eastern side of the country, an area which we have for a number of years now targeted for geographical expansion. Coupled with that, our sales of spring cereal seed has been good, about 6% above last year, which is outperforming the marketplace. And in addition to a large acreage planted in the autumn, which I referred to at the full year results back in January, our expectations are now of a very large harvest this year. Crops are looking good. So there'll be a good amount of grain to trade, which is good news for GrainLink because that's exactly what we do. As we look forward, we're very much focused on increasing market share, particularly in grain trading, and also following our recent capital investment at Astley, at Shrewsbury, we are very confident of increasing our market share of grass seed, not only in traditional grass seed mixtures, but also, and particularly so, in our environmental seed offering of grass seed mixtures, which include wildflowers, pollinators and herbs. As farmers now respond to incentives from the various government schemes, central government, the Environmental Land Management Scheme, and the devolved nation, particularly in Wales, of the Sustainable Farming Scheme, which will reward farmers to improve both wildlife habitats and also soil structure. The Glasson business, which I referred to as a subsidiary up in Lancashire, and part of this I think we've covered earlier in the presentation, particularly around the fertiliser situation in the first half. But I am particularly pleased how well the Glasson executive have managed this challenge by ensuring that our fertiliser stock levels throughout the process were kept to a minimum during critical periods. As a processor of blended fertiliser, we will always be in a position of what I call longer material. In other words, having more material than what you particularly sold, because that's what you need to do as a manufacturer. But as fertiliser prices are now at more sustainable levels, we are more confident that this will encourage increased sales going forward. In addition to the fertiliser business within Glasson, the feed trading activity performed well and certainly in line with expectations. However, the cost of living crisis has impacted sales of product manufactured within the specialist feed operation. I mentioned earlier on that we manufacture wild bird food particularly, and that the cost of living crisis has certainly reduced volumes there. But looking forward, those government and environmental policies that will reward farming for their environmental outcomes, we believe will reduce the total volume of fertiliser that will be used in the UK. But we see that as an opportunity at Glasson, because each farm will be now required to do a nutrient management plan. What that means is that each farm will need to analyse their soil to understand what is the nutrient value of the soil, phosphate, potash, for example. They'll also have to do a nutrient management plan that if they are applying any livestock manures becomes part of the fertiliser requirement. And the differential for optimum crop growth will then be from bought-in fertilisers. So the analysis of fertiliser will vary from farm to farm. And I think we at Glasson have an opportunity there because we are able to manufacture product to small runs of materials, i.e. lower volumes of tons in one go. So therefore, we'll be able to manufacture product which is specific to a certain farm. So whilst volumes will reduce to a degree, we see the opportunity of being able to enhance margin from bespoke fertiliser manufacture. And across the business at Glasson, we'll continue to seek efficiencies, particularly in that core mill I referred to reduce the cost of manufacturing, and that cost-saving programme is already underway. The depots, the 53 depots, revenues within the depots did increase over the period by 4%, but that was particularly driven by agricultural inflation, product inflation, and the profitability within the sector was impacted. So sales of certain good margin product groups such as Wynnstay branded bagged feed were down 10%. The main reason for that is chicken feed was down because of avian influenza. Many people with small chicken flocks, backyard flocks as I call them, they were reduced because of avian influenza. And also bagged feed to the sheep market was also reduced because April was a particularly mild open month whilst it was wet. So sheep feeding season was rather short as well. And hardware sales, within hardware, it's fencing materials. So farmer sentiment weakened, farmers tightened their belts a bit and would have put off replacing fences for another year maybe. And also costs within the sector would have increased. We were fortunate within the wider business that we had electricity contracts in place for our feed manufacturing sites, which absorbed the majority of electricity. But within the depots, we didn't. So therefore, we did enter new contracts from the 1st of November to the end of April. But I'm pleased to say now that the contracts we've entered now since the 1st of May forward are certainly more advantageous to the business. The depots do remain a very, very key route to market for Wynnstay. And what we will continue to do is upskill the staff that we have. Many of our staff, as Paul mentioned earlier, do come from agricultural backgrounds. They have a good knowledge of the sector. So our role is to increase their product knowledge, whether it be in animal health. We are one of the leading suppliers of animal health in the country. You'll notice on the right-hand side, I've quoted market shares there. It is a very fragmented market that we operate in. But Wynnstay would be the leading animal health supplier in the country at 12% market share. In order to do that, we have to have qualified people. So within the depots, we have about 200 people now who are qualified to be able to advise and sell animal health products. In addition to animal health, we train people on feed, on grassland products, on seed. And it does give us a point of difference over some of our competitors. So just moving forward to recap on our growth strategy, we also presented this a number of times before. The market we operate in, UK agriculture, is fairly mature. So our pillar of growth is very much organic on a slowly but surely basis, but also by acquisition, which we referred to earlier on. Manufacturing is key to our strategy. We seek those opportunities where we can bring more manufacturing to the business. Good example being Humphrey and Tamer of late. ESG is a key pillar, which I'll refer to in a second, and digital, which I've already referred to. But as we look to grow the business, we'll do it both organically and by acquisition. We are very proactive in searching for those acquisitions, but those acquisitions will need to add long-term value to the business and across both divisions, because it is absolutely clear that we do have the aim of maintaining a balanced business model right across the group. I'll ask Paul to just go on to our investments, if you would, please.
So as Gareth has mentioned, a clear pillar of our communicated strategy is investment in manufacturing efficiency and, where possible, adding value to a number of the commodities that we are involved with. We see this as the essential way of improving the net margins of the business. So there is a significant investment program in place for the business where we anticipate investing up to 25 million over the next 3 years in such manufacturing efficiency programs. Gareth's already explained the Cairn mill redevelopment program that was associated with the Humphreys acquisition, which we had previously highlighted at an approximate cost of some 30 million, representing about half of that investment program. But in addition to this, we have already improved the production capacity and efficiency elements of our seed processing plant in Shrewsbury, and we have further plans now to invest in 30,000 square feet of additional warehousing to improve distribution efficiency on that site at probably a cost of some £3 million. The Carmarthen Mill project, Gareth has mentioned earlier on, to potentially double the manufacturing capabilities at that site. And the photograph on the right-hand side is the first phase of that, the finished product storage and dispatch facility. So we were about halfway through that £6 million project. But also excitingly, we have an interest in renewable energies programme where we've allocated £5 million to effectively produce electricity to eliminate the majority of our scope 2 carbon emissions, those from bought-in electricity. 1 million will be spent on that project in the first year, but as well as ticking the important milestones towards our net zero target, it's an extremely attractive proposition, providing a 25% return on investment, because we are very much able to consume the electricity that is generated directly within the manufacturing sites where we're going to be installing these solar arrays. So again, when that building on the right-hand side is actually fully clad, the roof will basically consist of solar panels. And again, as has already been mentioned, we continue our investment in our colleague base, where upskilling of staff is a critical USP for this business.
ESG is a pillar of our strategy, and as a business, we have a clear ambition of becoming carbon neutral by 2040. And that will be as a result of activities that we do within the business. We are progressing well, and we will prepare a TCFD report for the 2023 annual report. To help us deliver our ambitions, we have now engaged with a sustainable farm advisory team, and that's working well. So that team consists of experts from within the industry, senior experts who have a knowledge and experience of sustainability, and also with the appointment of recently now the non-executive director, Stephen Eastham. He also brings a wide knowledge of the food industry, or the food supply chain to our business as well. I'd just like to mention really that in addition to some of the national charities that we seem to support, whether it be Children with Cancer or the Royal Agricultural Benevolent Institution, or RABI is often known, many of us work and live within the rural communities. I was just looking last week actually that we're currently supporting in excess of 230 projects, events, agricultural shows, etc., within the communities that we work and live. How are we supporting our farmers deliver their environmental outcomes? As you're aware, environmental legislation, which is now being introduced to our farmers by both central and devolved governments, actually does support our growth strategy exceptionally well. So we're engaged with our farmers, as I mentioned earlier on, with nutrient management plans to enable them to seek optimum plant growth and reduction of pollution. improving their soil health with deep-rooted herbs and rotations. From the livestock sector, improving animal health through animal health plans. Those trials that we're carrying out to reduce phosphate, for example, and to ensure right across the business that we are committed to seeking both raw materials and products for resale that have been sustainably manufactured and grown. So as a business, we continue to seek both innovative products and to provide help and advice so that our farmers can deliver their environmental and sustainability targets by collaboration throughout the food chain. And a good example of that collaboration is a trial that we're sponsoring at Harper Adams University College. That is a 15-acre site looking at varieties of soya. So soya, there's no soya actually grown commercially in the UK at this moment in time. The majority comes from the Americas. And I was thinking myself, actually, about 25 years ago, there was very little forage maize grown on the western side of the country. That is now very much part of the crop rotation on many dairy farmers. So maybe there will be the opportunity once we look at varieties, etc., of growing soya in the country. But I'll certainly keep you updated with the developments of that opportunity over the next year or so. I'd just like to highlight a point of difference that we do have as a business, and that's the agricultural events that we hold for our customers. Very clearly a point of difference over many of our competitors. We hold an arable event on an annual basis. It's held at Shifnal near Telford. And on a biannual basis, we hold a beef and sheep event. And this is really for our customers to look at new technologies, sustainable farming techniques, as I mentioned earlier on, whether it be soil health. If you look at the picture on the left-hand side, in the bottom left, that's a working demonstration of minimum tillage. So therefore, disturbing the soil less, and there'll be less carbon going to the atmosphere. Then there's trial plots, up-to-date varieties, new varieties being introduced, so our farmers can come and see whether those varieties are appropriate for them to use in the future. Industry speakers and also workshops across the products that we sell. So what we're looking to do here as a business is promote Wynnstay very much as the one-stop shop for innovation, products and advice, and effectively helping our farmers to feed the UK in a sustainable way. So I think in summary and the outlook, the business has performed well. It has been a challenging environment. And whilst the full year outcome is likely to remain dented as a result of adverse stock realisations at Glasson, prospects for the second half of the year are encouraging, particularly within the arable sector and also the recovery of the free-range egg sector. Looking forward, the long-term future of British agriculture and food production remains strong, as both food security and food self-sufficiency have certainly risen up the political agenda. And that's really as a result of some of the global issues, the Ukraine crisis, for example, and also the COVID pandemic as well. So the Wynnstay Group board is very confident that as a business, Wynnstay is well placed to deliver objectives, not only in the short term for the full trading year, but also beyond. And our strong cash position, our robust balance sheet, and particularly that balanced business model, which does provide us with the internal hedge, will allow us to continue to invest not only within the business, but also seek those acquisitions, which will add scale and the ability to deliver long-term growth alongside our strategic ambitions. So that brings me to the end of the presentation, and we're very happy to take questions in due course.
And the first question is about the egg market, which has been through a difficult time with bird flu. I noticed that your statement mentioned that the free-range egg market is now beginning to recover. It's obviously an important feed sector for you. Can you update us on the current state of the market?
Yeah, there's two sides to that. Then there's economics, in addition to bird flu. So maybe if we look at economics first and foremostly. I think over the last 12, 18 months, margins within free-range egg production has certainly been impacted twofold in many respects. Price of egg to start with. The supermarkets were keeping egg at a reasonably low level. And also at the same time, the cost of feeding the hen went up because grain went up. As a result of that, some farmers chose not to restock The facilities were kept there. But the bird cycle, a laying bird cycle, a bird comes into lay at 16 weeks of age, and then ends its laying life effectively at 76 weeks of age. So it is a fairly quick turnaround cycle as such. So some people chose not to restock. And what we've seen then since then is that feed has come down in cost, and the price of egg has gone up now at a record level. So margins are looking particularly strong, and certainly we'll see that coming through into the end of the second half of our financial year and certainly into next year. The impact of avian influenza that has tailed off to a degree. I mean, it hasn't gone away, so please don't get me wrong there. But we're certainly seeing in our pullet business now that farmers are placing orders for pullets. So the Humphrey pullet business is about rearing chicks from 1 day of age up to 16 weeks, and then they become a laying bird. And our orders for there, we've effectively got a full book now. I know that our competitors will be in the same situation. So certainly confidence has come back to the free-range egg sector.
And I see that inventories reduced as fertiliser replacement costs fell, but this was more than balanced by adverse year-on-year movements in receivables and payables. Were these year-on-year movements linked, or were there other factors? And is working capital fairly normal for this time of year?
Quite a few elements to that question. Just taking the inventories firstly, that fall in price scenario has certainly impacted the carrying volumes and indeed the lower values of fertiliser inventories. So that was a significant element. The prices were already slipping, so we were being particularly cautious. Obviously, that didn't compensate sufficiently for the very violent drop in prices, the 30% drop that was experienced in March. So it very much is a fertiliser-driven scenario as far as stocks are concerned, but also that crosses over into other elements of working capital, particularly on the payables side, which has reduced year on year. A lot of the fertiliser raw materials are actually offered from traditional suppliers on extended credit terms. The absence of some of those suppliers, partly because of the sanction regimes and partly because of the reorganisation of the shortage of materials, we've not been able to benefit from some of those extended payment terms, and they've all contributed to those balance sheet numbers that were reported at the end of April. Certainly, as far as working capital is concerned, we are already experiencing the reversal that was anticipated, which, as I said earlier on in the presentation, has actually been exacerbated by the deflationary environment that we're now operating in, which will result in a lot less cash being tied up by the time we get to this year end, probably compared to the previous year.
It's 16 months since the company's acquisition of Humphreys Feeds in March 2022. You mentioned that the redevelopment of the mothballed mill at Cairn remains under consideration. When is a decision likely, and what are the current cost estimates involved? And should the redevelopment not proceed in the manner originally proposed, will this result in a write-down in the value of the acquisition, and if so, to what extent?
I'll cover just the first part of that, maybe, and Paul will cover the financials, if that's okay. So as far as the development of the site at Cairn, we cleared a lease, a peppercorn rent on the site at Twyford. So we purchased the site at Cairn from the Humphrey business. It was already part of the Humphrey business whilst it was closed. And that gave us the opportunity then to consider whether that was the right place to develop our next manufacturing facility. So when we bought it, we had tabled the fact that we felt we could redevelop it for 13.5 million. We put that in the public domain. Cost increased from there with the COVID pandemic and the Ukraine crisis, etc. Well, certainly the Ukraine crisis in this particular case. So at this moment in time, we are considering a number of options. You asked the question as to when do I think we'll be in a position to give more detail on those options. It'll be into the autumn months when we've concluded to the best way forward. But I can assure you there's a number of options ongoing, and we will have a facility in the southwest.
The board is very confident that those options will provide the ability to actually satisfy the acquired Humphrey volumes. So the risks of write-downs, as was mentioned in the question, is minimal. There are various alternatives that the company can use to manufacture the required Humphreys volume. Obviously, our preferred opportunity remains the development of a multi-species mill, Humphreys being poultry only. The strategic opportunity in the southwest is for us to develop a ruminant feed activity, and because of inflationary pressures on the initial costs, it's those added complications that we are currently in a process of refining before we finalise what our end decision is going to be, and the precise nature of the development that we're going to initiate.
And is there an earn-out for Humphreys?
Yes, the acquisition arrangements did include an earn-out arrangement, which was based on volumes. That earn-out period has now concluded, and the earn-out arrangements have been paid and are recorded within the results that we have announced. The earn-out did not reach the maximum amount, which was a total of some £2 million, with the payout actually being 1.1 million, based on volumes, with obviously volumes being depressed for the reasons that Gareth explained. The avian influenza affected the volume and therefore the level of earn-out. But that is now all reported and concluded in those interim results.
And can you say a bit more about the fertiliser market? Has some of the competition dropped out, and are there acquisition opportunities in this market?
Yeah, as far as the market is then, so I suppose we take a last 2-year period, volumes have dropped to a degree as the price of fertiliser went to £1,000 a tonne, certainly in the livestock sector. Maybe some of those volumes have dropped as people have utilised, quite understandably, farmyard manure is far better than they did previously. Within that period, there's a large US business by the name of CF Industries. They were the largest manufacturer, or the only manufacturer of ammonium nitrate in the UK. And you may recall back to the period when carbon dioxide shortages were seen as an issue. The government actually came when CF actually closed production because of economics. The government came to an agreement that they would subsidise that to a degree to continue. Anyway, post that, CF have now closed the one plant at Ellesmere Port, which is, broadly speaking, has a capacity of 1 million tonnes of fertiliser, both ammonium nitrate and what we call NPK compounds. So the only plant they now have in the UK is up at Billingham in the northeast. So yes, the competition has decreased. What opportunities does that bring for us as Glasson? There is a void because the market certainly isn't back to the scale that CF have closed production of. So there's a void there and an opportunity, particularly in NPK blended manufacturers. So yeah, there is an opportunity. We as Glasson, we still use CF as a supply of ammonium nitrate as a raw material, in addition to importing as well.
And can you say a bit more about the digital offering? Do you think that you'll be able to develop it further?
Yes, the continued use of online trading is inevitable in our marketplace. I think in agriculture, it probably has lagged a little behind other sectors for some of the reasons that Gareth explained. But our investment in this area continues because we recognise that ultimately more and more activity is likely to migrate online. So although our current offering requires customer identification, because primarily those people who do want to trade would like to book the transaction to their credit account, and that remains an important differentiator for us. So we want to maintain the offering of that benefit, but whilst making the site wider and easier to use. We currently have around 5,000 lines listed on the site, and we're rapidly commencing our next phase of development, which will be effectively click and collect in customers' local depots.
Can you say a bit more about the new environmental land management schemes that you referred to? Is there increased impact over time, positive or negative, for you over the next few years?
So the Environmental Land Management Scheme is a scheme which is related to central government, so therefore England. Will it be positive? What's the change? Let me start with the change of it all then, really. So under the Common Agricultural Policy, farmers were effectively paid for how many acres they farmed. So irrespective of whether you were efficient or not, if you had similar acreage, me farming 300 or to the guy next door farming 300, irrespective of how good we were or indifferent, we get the same amount. So that is certainly changing now. So the Environmental Land Management Scheme is very much about coming out of that Common Agricultural Policy scheme. And 2024 will be the halfway point in the transition. So in 2024, farmers' incomes, as far as government support, 50% will come from the old land-based scheme and 50% will be from environmental and efficiency programs. For Wynnstay long term, we see this as very positive, because those farmers who will be rewarded will be the efficient farmers who are seeking to invest in the business and resell products and services, and also those who are very keen to support environmental outcomes. And our product offering, whether it be environmental seed mixtures, the nutrient management plans and the bespoke fertilizers, investment in the infrastructure of containing farm manures and slurries, and newer seed varieties and newer farming practices is very much what we do. So for Wynnstay, we see it as positive long term.
Tremendous. Thank you very much indeed. And that's the end of questions. Gareth, do you have any closing remarks?
Other than to thank everybody for joining us this afternoon. And if anybody should wish to follow up the presentation with a discussion with Paul or myself, we're always available.